Imagine walking into your local bank tomorrow morning, the same bank you've trusted with every dollar you've ever saved, and finding the doors locked. A small handwritten note taped to the glass reads, "Closed by the board of directors until further notice." No explanation, no timeline, no promise that your money will ever come back to you. Now, imagine that there is no safety net, no government agency standing behind your deposits, no insurance, no guarantee of any kind. If that bank goes under, your life savings vanish with it, and there is absolutely nothing you can do about it. For most of American history, that was reality. For over 150 years, putting your money in a bank was essentially an act of blind faith. You were trusting that the people running the institution were honest, that they wouldn't gamble your deposits on risky ventures, and that if fear swept through your town, enough cash would be sitting in the vault to hand back to every person who came asking for it. And time after time after time, that trust was broken, exposed, shattered. Entire communities were financially gutted overnight. Families reduced from modest comfort to destitution, not because of anything they did wrong, but because the system they depended on had no floor beneath it. When a bank failed, you didn't file a claim, you didn't call a hotline, you stood in line, you begged, and more often than not, you walked away with nothing. This is the story of what happened before 1933, before the Federal Deposit Insurance Corporation existed, when ordinary Americans had no protection whatsoever against the recklessness, the greed, and the outright fraud of the institutions they entrusted with everything they had. And honestly, the fact that it took this long, that it took the worst economic catastrophe in the nation's history to finally force the government's hand, well, that tells you everything you need to know about where power really sat in America's financial system. To understand how we got to 1933, you have to go back much further. You have to understand what American banking looked like in its earliest days. Because this wasn't some modern regulated system with oversight committees and transparency standards. Early American banking was chaotic, fragmented, and often lawless. There was no central bank for most of the country's history. There was no unified currency, and there was certainly no guarantee that the bank on the corner of your street would still be standing next month. In the early 1800s, anyone with enough capital and the right political connections could essentially open a bank. States handed out banking charters with alarming frequency, and the institutions that sprang up were wildly uneven in quality. Some were run by experienced, cautious financiers. Others were operated by speculators and outright conmen who saw a bank charter as a license to print money, sometimes literally. These banks issued their own banknotes, their own paper currency, backed by whatever reserves they claimed to have. A traveler moving from one state to another might carry notes from 3 or 4 different banks, each trading at a different discount depending on how much confidence the market had in that particular institution. It was a mess, a deeply unstable, deeply unregulated mess. And so, predictably, banks failed constantly. In the first half of the 19th century, bank collapses were so common that they became almost routine between 1809, when the Farmers' Bank of Gloucester in Rhode Island became the first bank to fail in the independent United States. In the Civil War, hundreds of banks went under. Each failure wiped out depositors, destroyed local economies, and eroded whatever fragile trust existed in the banking system. The pattern was always the same. A bank would extend too many loans, or its managers would engage in speculation, or a sudden economic downturn would trigger a wave of withdrawals that the bank simply could not meet. And then the doors would close, and the people who had trusted that institution with their money were left holding worthless paper. Now here is where something genuinely interesting happened, something that most people don't know about. The idea of insuring bank deposits did not begin with Franklin Roosevelt in 1933. It actually traces back over a century earlier to a man named Joshua Foreman, a businessman from Syracuse, New York, who proposed something radical for his time. In 1829, with the support of Martin Van Buren, who was then the governor of New York and would later become president, the state of New York established what they called the Safety Fund. This was America's first ever bank deposit insurance scheme, and the concept was elegant in its simplicity. Every state-chartered bank was required to make annual contributions to a common fund. If any participating bank failed, the fund would be used to pay back depositors and other creditors. 3 bank commissioners were appointed to examine the financial health of these institutions and report back to the legislature. It was in theory a brilliant innovation. For the first time, there was an organized system designed to catch a failing bank before it destroyed the people who depended on it. And for a while it worked. The safety fund operated reasonably well through the early 1830s. Banks contributed their premiums, the commissioners conducted their examinations, the public gained a measure of confidence in the system. But then came the panic of 1837, and the whole thing buckled under pressure. Multiple banks failed in quick succession, and the claims against the fund far exceeded what it had accumulated. The insurance scheme, which had looked so promising just a few years earlier, was overwhelmed. By 1842, New York was forced to amend the law, restricting the fund's coverage to banknotes only, essentially abandoning deposit protection altogether. The experiment had failed its first major test, but the idea didn't die entirely. Over the following decades, other states tried their own versions. Vermont, Indiana, Michigan, Ohio, and Iowa all established some form of bank guarantee program before the Civil War. Indiana's system was actually quite successful because it took a much harder line on bank supervision. The participating banks mutually guaranteed each other's obligations, and the oversight was rigorous enough that Indiana managed to avoid bank failures entirely during its program's 30-year run. But Indiana was the exception, not the rule. Most state programs either ran out of money during financial crisis or were undermined by the changing structure of the banking system itself. When the National Bank Act was passed in 1863 during the Civil War, it fundamentally reshaped American banking. The act created a system of nationally chartered banks and imposed a tax on state banknotes that was so punitive it effectively drove most state banks to convert to national charters. This mass migration hollowed out the remaining state insurance funds. They no longer had a broad enough base of contributing banks to be viable. One by one, these early experiments and deposit insurance collapsed. By the late 1860s, America was left with no deposit protection of any kind at any level of government, and so the cycle continued. Without insurance, without a central bank, and without any meaningful regulatory framework, the American banking system lurched from one crisis to the next, each one more devastating than the last. The pattern became grimly predictable. Economic expansion would fuel speculation and overlending, then some shock. A crop failure, a stock market crash, a railroad bankruptcy would trigger a wave of fear. Depositors would rush to withdraw their funds. Banks that were perfectly solvent on paper would find themselves unable to meet the sudden demand for cash, because the fundamental reality of banking is that no bank keeps enough cash on hand to pay out every depositor at once. The money is out on loan, it's invested, it's working, and when everyone comes asking for it back at the same moment, the system seizes. The Panic of 1873 was one of the first great demonstrations of this vulnerability on a national scale. The crisis was triggered by the failure of J. Cook and Company, one of the most prestigious banking houses in the country. Cook had overextended himself financing the Northern Pacific Railway, and when the firm collapsed, it sent shockwaves through the entire financial system. The New York Stock Exchange actually shut down for 10 days, the first time that had ever happened. Banks across the country suspended payments. Businesses that depended on credit were strangled. The resulting depression lasted 6 years. 20 years later, the Panic of 1893 hit even harder. This time, the trigger was a complex mix of factors, including overbuilding of railroads, a decline in the Treasury's gold reserves, and the crisis of confidence among foreign investors who began pulling their capital out of American markets. As concern about the economy deepened, depositors across the country rushed to pull their money out of banks. In 73 cities, clearinghouses partially suspended cash payments. Currency was hoarded. Gold and silver traded at a premium over checks drawn on banks. Even in financial centers like Boston and New York, hundreds of banks suspended operations. Railroad companies, which had been borrowing recklessly for years, collapsed by the dozen. The Reading Railroad, the National Cordage Company, and scores of other firms went bankrupt. Unemployment surged to somewhere between 17 and 19%. Silver mines shut down across the West. Farmers who had borrowed to expand during the boom years watched their land get seized. And through all of it, ordinary depositors who had trusted their savings to the banking system found themselves at the mercy of forces they didn't understand and couldn't control. But it was the Panic of 1907 that truly exposed just how fragile, how dangerously ad hoc the entire American financial system really was. And this panic didn't start with some massive economic shock or foreign crisis. It started with a copper scheme. A group of New York speculators, led by a man named Augustus Hines and his associate Charles Morse, attempted to corner the market on shares of the United Copper Company. The gamble was audacious and, as it turned out, catastrophically stupid. The scheme collapsed on October 16th of that year. United Copper stock, which had been trading at around $30 a share, plummeted to $10 in a single day. Now, the failure of one speculative scheme shouldn't have been enough to bring down the banking system of the world's largest economy. But Hines and Morse had deep connections to some of New York's most prominent financial institutions. Hines was president of the Mercantile National Bank. Morse sat on the boards of multiple banks and trust companies. And when word of their losses spread, depositors didn't stop to ask whether their particular bank was directly exposed. Fear is not surgical. Fear is a wildfire. It jumps from institution to institution, feeding on rumor and uncertainty. And in an environment with no deposit insurance, that fear is existential. Every depositor knows that the last person in line gets nothing. The run spread first to the Mercantile National Bank. The New York clearinghouse stepped in, forced Hines to resign, examined the books, and declared the bank solvent. That calmed things temporarily, but then attention turned to the Knickerbocker Trust Company, the third largest trust company in New York City. Its president, Charles Barney, was an associate of Morse, and was rumored to have been involved in speculative ventures. On October 21st, the National Bank of Commerce announced that it would no longer act as Knickerbocker's clearing agent. That was a death sentence. It meant other banks would no longer cash Knickerbocker's checks. It meant the broader banking system was washing its hands of the institution. It meant that whatever liquidity problems Knickerbocker had, it was now on its own. The next morning, a crowd of depositors formed outside Knickerbocker Trust's headquarters at the corner of 5th Avenue and 34th Street in Manhattan. Picture the scene. Hundreds of people, many of them working-class New Yorkers who had entrusted their entire life savings to this institution, standing in a line that stretched down the block and around the corner. Some had been there since before dawn. Inside, tellers were frantically counting out cash, trying to meet the relentless demand. In roughly 3 hours, depositors withdrew approximately $8 million. And then the money ran out. Knickerbocker's doors were shut, just like that. Hundreds of people were still standing in line when the announcement came. Their money was gone. The closure of Knickerbocker sent genuine terror through the financial system. If the third largest trust company in New York could be shut down in a matter of hours, then nowhere was safe. Runs immediately spread to the Trust Company of America, Lincoln Trust and others. Over 2 days, the Trust Company of America saw $13 million in withdrawals out of roughly $60 million in total deposits. Regional banks across the country began recalling their reserves from New York to protect themselves, which only drained more liquidity from the system. The stock market lost nearly half its value from the previous year. The real gross national product fell 11%. Factory production dropped 16%. And here is the part of the story that should disturb anyone who believes in the idea of a functioning democratic government. The United States had no central bank. There was no Federal Reserve to inject emergency liquidity. There was no government agency with the authority or the resources to stabilize the banking system. The fate of the American economy in this moment of absolute crisis rested in the hands of one man, and that man was J.P. Morgan, a private citizen. A very wealthy private citizen to be sure, but a private citizen nonetheless. Morgan organized a group of New York's most powerful bankers and essentially locked them in his private library on Madison Avenue. He told them that if they didn't pool their resources and provide emergency loans to the failing trust companies, the entire financial system would collapse. It was an extraordinary scene. The most powerful financiers in the country sitting in the mahogany panel study of a single individual, being told that they had no choice but to act because their government would not. Morgan himself committed millions. The Treasury Secretary George Cortelyou deposited $25 million of government funds into New York banks. John D. Rockefeller pledged $10 million more and telephoned the Associated Press to make sure the public knew about it. Together, this ad hoc coalition of private wealth managed to stop the bleeding, but only barely and only after enormous damage had already been done. The panic of 1907 finally convinced enough lawmakers that something had to change. In 1908, Congress established the National Monetary Commission to study the banking systems of Europe and proposed reforms. The commission spent 4 years investigating, and its work eventually led to the passage of the Federal Reserve Act in 1913, which created the nation's central bank. The Federal Reserve was supposed to be the answer to the problem of banking panics. It was supposed to serve as a lender of last resort, injecting liquidity into the system during moments of stress so that solvent banks wouldn't be destroyed by irrational runs. And on paper that sounded like a solution. But the Federal Reserve, as it turned out, was not the end of the story, not even close. Because the creation of a central bank did nothing to address the fundamental vulnerability of ordinary depositors. There was still no insurance. There was still no guarantee that the money you put into a bank would be there when you needed it back. And what happened next? What happened in the years between 1929 and 1933 would prove to be the most devastating banking catastrophe in the history of the United States. Now, the 1920s are often remembered as a period of exuberant prosperity. The Roaring Twenties, Jazz Age America, flappers and speakeasies, and soaring stock prices. And for many Americans, particularly those in cities with access to the booming industrial economy, it was a genuinely prosperous time. But underneath that glittering surface, the banking system was quietly rotting. An average of more than 600 banks failed every year between 1921 and 1929. 600 banks a year, and most Americans barely noticed. The reason they didn't notice is that these failures were concentrated among small rural banks, many of them single-office institutions and agricultural communities that had been struggling since the end of the wartime commodity boom. The farm economy had been in recession for most of the decade, and the small banks that served farming communities were dragged down with it. Only 8 states had any form of deposit guarantee fund, and those funds were woefully undercapitalized. The rest of the country had nothing. If your bank failed, you were simply out of luck. Between 1921 and 1929, those 600-plus annual failures involved relatively modest amounts of money, and they affected communities that the financial and political establishment in New York and Washington largely didn't care about. Small farmers, small-town merchants, people without political influence or media visibility. Their losses were treated as the natural cost of doing business in a free market economy. Banks fail. it happens. That was the prevailing attitude among the nation's financial elite. The thought of insuring deposits was considered not just unnecessary, but actively dangerous. The argument went something like this. If you guarantee people's deposits, you remove the incentive for depositors to monitor their banks. Banks will become reckless because they know the government will bail them out, and the market discipline that keeps banks honest will be destroyed. It was a compelling argument in theory. In practice, it was a fantasy. Ordinary depositors had never had any meaningful ability to evaluate the soundness of their bank. They couldn't examine the loan portfolio. They couldn't audit the books. They were trusting blindly. And the system was designed to keep them that way. And then the stock market crashed. On October 29, 1929, the day they called Black Tuesday, the New York Stock Exchange experienced the most catastrophic single-day decline in its history. 16 million shares were traded in a frenzy of panicked selling. Fortunes evaporated. The ticker machines fell hours behind, so investors couldn't even know in real time how much they were losing. But the crash itself, as devastating as it was, didn't immediately cause the banking crisis. What the crash did was shatter confidence. It exposed the speculative excesses that had been building for years, and it set in motion a chain of events that would, over the next 3.5 years, systematically dismantle the American banking system. The first major banking crisis of the Great Depression era began in the fall of 1930. In November, a large financial conglomerate called Caldwell & Company, based in Nashville, Tennessee, collapsed. Caldwell was the largest investment banking firm in the South, and it had deep connections to banks across the region. When it went down, it took the Bank of Tennessee with it. 2 more affiliated banks in Knoxville failed within days. Panic spread through Tennessee, then jumped to Kentucky, Arkansas, and North Carolina. Depositors in these states, having watched their neighbors' banks close, rushed to pull their money out of their own institutions. 256 banks suspended operations in November alone. Another 352 failed in December. And then, on December 11, 1930, came the event that truly sent a chill through the entire nation. The Bank of the United States, based in New York City, closed its doors. Now, despite its grand and somewhat misleading name, the Bank of the United States was not a government institution. It was a private commercial bank. But it was the 4th largest bank in New York City, with deposits of approximately $200 million and more than 400,000 depositors. Many of those depositors were recent immigrants, working-class families who had scraped together modest savings and entrusted them to an institution whose name suggested government backing. They were wrong, and they paid dearly for that mistake. The collapse of the Bank of the United States was a preventable disaster. The New York Federal Reserve Bank had been working to arrange a merger with another institution that would have saved the bank and protected its depositors. But the negotiations fell apart, partly because of anti-Semitic bias against the bank's largely Jewish clientele and management, and partly because the other banks involved didn't want to absorb what they perceived as bad assets. When the merger collapsed, depositors rushed to withdraw their funds. The bank's two heads, Bernard Marcus and Saul Singer, had been purchasing their own bank stock with bank funds to artificially inflate its price, handing out enormous amounts of unsecured loans to insiders. When the truth came out, they were sent to prison. But by then it was too late. More than 44,000 depositors had accounts of less than $400. These were not wealthy speculators. These were working people who had lost everything. The failure of the Bank of the United States sparked a wave of hoarding across the country. People who still had money in banks began pulling it out, not because their own banks were in trouble, but because they had lost faith in the entire system. And that loss of faith became a self-fulfilling prophecy. When enough people withdraw their deposits, even a perfectly healthy bank can be forced to close. The cash simply isn't there. It's out on loan to businesses and homeowners. It's invested in bonds and securities. The bank might be completely solvent on paper, with assets that exceed its liabilities, but solvency means nothing when 300 people are standing in your lobby demanding cash that you physically do not have. Between 1930 and 1933, the United States experienced 4 distinct waves of banking panics. Each one was more severe than the last. The Federal Reserve, which had been created specifically to prevent this kind of catastrophe, largely failed to act. In some districts, reserve banks provided emergency lending to struggling institutions. In others, they stood by and watched. There was no coordinated national response. The prevailing orthodoxy at the Fed held that bank failures were a natural and even necessary corrective process, that the weak institutions needed to be weeded out so the strong could survive. It was economic Darwinism applied to banking, and it was catastrophic. By the numbers, the devastation was staggering. In 1930, roughly 1,350 banks suspended operations. In 1931, the number rose to nearly 2,300. In 1932, another 1,453 went down. And in 1933, the final year before deposit insurance was established, approximately 4,000 banks failed. Over those 4 years, more than 9,000 banks closed their doors across the country. Depositors lost more than $1.3 billion, which in today's money translates to roughly $27 billion. About 19.6% of total deposits in the failed institutions were wiped out. But the raw numbers don't capture the human reality. By March of 1933, approximately 9 million Americans had lost their savings. Think about what that means. 9 million people who had done nothing wrong, who had simply put their money in a bank because that is what responsible people do, woke up one morning to discover that their financial lives had been erased. Retirement funds gone, college savings gone, emergency reserves gone, everything they had worked for, every dollar they had set aside for the future, swallowed up by a system that had no mechanism to protect them. And these weren't just abstract losses. Behind every statistic was a family. A retired school teacher who had saved for 40 years. A small business owner whose operating capital vanished overnight. A young couple who had scraped together a down payment for their first home, only to see it disappear. In towns where the local bank was the only bank, a failure didn't just hurt individual depositors. It destroyed the entire community. Businesses couldn't make payroll, farmers couldn't buy seed, merchants couldn't stock their shelves. The money that had been circulating through the local economy simply ceased to exist, and the economic life of the community ground to a halt. What made it worse, what made it absolutely enraging, was that many of these failures were the direct result of incompetence, recklessness, or outright fraud on the part of bank management. Banks had lent money for wildly speculative investments. They had extended dangerously large amounts of credit to financial speculators. Some had used depositors' funds to buy their own stock, inflating their share prices in a scheme that would today land them in federal prison. And when the bubble burst, it wasn't the bankers who paid the price. Many bank executives walked away from their failures with their personal fortunes intact, protected by corporate structures that shielded their private assets. The depositors were the ones left holding the bag. By the winter of 1932 to 1933, the crisis had reached a point of total systemic collapse. Banking conditions deteriorated so rapidly that individual states began taking desperate unilateral action. On February 14, 1933, the governor of Michigan declared an 8-day bank holiday, freezing the funds of 900,000 depositors. The closure was so unnerving that it triggered a chain reaction across the country. Within weeks, governors in Indiana, Maryland, Arkansas, Ohio, and other states followed suit, shutting down banks in their jurisdictions to prevent further runs. By the time Franklin Roosevelt was inaugurated on March 4, 1933, the American banking system had essentially ceased to function. Scarcely a bank in the country was open for business. Roosevelt acted immediately. On March the 6th, he declared a national bank holiday, shutting down every bank in the United States, including the Federal Reserve. It was an extraordinary exercise of executive power, and it was absolutely necessary. For 4 days, the country operated without a functioning banking system. People couldn't access their money. Businesses couldn't process transactions. The nation's economy was literally frozen. During those 4 days, Treasury officials and congressional leaders worked around the clock to craft the Emergency Banking Act. The legislation was introduced, debated, and passed by Congress on March 9th in a single day. Members of the House voted on it before printed copies were even available. That's how urgent the situation was. The act gave the government the authority to examine bank finances, provide needed capital, and determine which institutions were healthy enough to reopen. It was triage on a national scale. But Roosevelt understood that the legislation alone wouldn't be enough. The real problem wasn't technical, it was psychological. The American public had lost faith in the banking system, and no amount of legislation would matter if people refused to put their money back into banks. So on the evening of March 12th, the night before banks were scheduled to begin reopening, Roosevelt delivered his first fireside chat. Speaking to a radio audience of more than 60 million people, the largest audience ever addressed by an American president, Roosevelt explained in plain conversational language what had happened, what the government was doing about it, and why it was now safe to return their money to the banks. He told the American people something simple and direct. He said it was safer to keep your money in a reopened bank than under the mattress. And the remarkable thing is, they believed him. The next morning, when the first banks reopened in the 12 Federal Reserve Bank cities, depositors didn't line up to withdraw more money. They lined up to put it back. Within a week, Americans returned approximately $1 billion to the banking system. It was one of the most dramatic reversals of public sentiment in American history. And it worked because Roosevelt had done something that no previous president or government official had managed to do during the crisis. He had spoken directly to the people, in language they could understand, and given them a reason to trust. But the Fireside Chat and the Emergency Banking Act were only the beginning. Roosevelt and his advisors knew that the underlying structural problem and the absence of deposit insurance had to be addressed once and for all. The idea of federal deposit insurance had been proposed repeatedly over the previous half-century. Between 1886 and 1933, Congress had considered 150 separate proposals for some kind of national deposit guarantee system. Every single one had been blocked, primarily by the banking industry itself. The large banks, the money center institutions on Wall Street, had consistently and aggressively opposed deposit insurance. Their argument was that it would force well-managed banks to subsidize the failures of poorly run institutions. It was the same argument that had been made against state-level insurance schemes a century earlier, and it carried enormous political weight because the banking lobby was one of the most powerful forces in Washington. But by 1933, the political landscape had shifted dramatically. The public was furious. 9 million people had lost their savings. Unemployment had reached 25%. The banking system had literally collapsed. The man who had been championing federal deposit insurance most vocally was a congressman from Alabama named Henry Stigall, the chairman of the House Banking and Currency Committee. Stigall represented a rural district where small banks served farming communities, exactly the kind of banks that had been failing in droves throughout the 20s and early 30s. He understood in a way that the Wall Street establishment did not, that the small depositor, the farmer, the teacher, the shopkeeper needed protection. On the Senate side, Carter Glass of Virginia, a powerful figure who had helped draft the Federal Reserve Act 2 decades earlier, was pushing his own banking reform legislation. Glass was actually skeptical of deposit insurance. He viewed it as a subsidy for bad banking, but Stigall had the leverage. The public wanted deposit insurance, and in the political climate of 1933, opposing it was electoral suicide. The two men eventually found common ground, and the result was the Banking Act of 1933, commonly known as the Glass-Steagall Act. Among its many provisions, the act created the Federal Deposit Insurance Corporation. The FDIC began operations on January 1, 1934. Under a temporary plan, all deposits were insured up to $2,500 per account. That initial coverage limit was modest, but its psychological impact was enormous. For the first time in American history, ordinary depositors had a guarantee, backed by the full resources of the federal government, that their money was safe. If a bank failed, the FDIC would step in and pay depositors up to the insured limit. The era of losing everything because your bank made bad loans or your bank's president was a crook, that era was over. The results were immediate and dramatic. In the year before the FDIC was created, more than 4,000 banks had failed. In 1934, the first year of deposit insurance, that number dropped to 61. It was the most dramatic improvement in banking stability in American history. Bank runs, which had been a recurring feature of American life for over a century, essentially disappeared. The reason was simple. When depositors know that their money is insured, they have no incentive to panic. There's no reason to stand in line at dawn, no reason to rush to be first through the door. Your money is guaranteed. The fear that fueled the runs was extinguished at its source. Now, it's worth stepping back and asking why this took so long. Why did it require the worst economic catastrophe in the nation's history to establish something as basic as deposit insurance? The answer lies in power, specifically in who held it. For most of American history, the banking industry had an outsized influence over financial regulation. The large banks opposed deposit insurance because they didn't want to pay for it, and because they believed, with considerable justification, that it would reduce the competitive advantage they held over smaller institutions. A depositor choosing between a large, seemingly stable money center bank and a small rural bank would naturally gravitate toward the larger institution if there was no insurance. Remove that fear, and suddenly the small banks become viable competitors. The big banks understood this dynamic perfectly, and they fought deposit insurance at every turn. But there's a deeper issue here as well, and it gets to the heart of how America has historically thought about the relationship between individuals and institutions. The prevailing ideology, particularly among the financial and political elite, held that individuals were responsible for their own financial decisions. If you chose to deposit your money in a bank that later failed, well, you should have done your due diligence. You should have examined the bank's balance sheet. You should have assessed its loan portfolio. You should have been a more careful consumer. This was, of course, absurd. The average depositor in 1925 or 1930 had neither the tools nor the expertise to evaluate the soundness of a bank. They were operating in an information vacuum, trusting institutions that were under no obligation to disclose their true financial condition. But the fiction of individual responsibility served a useful purpose for those who profited from the status quo. It absolved the powerful of any obligation to protect the vulnerable. What's fascinating is looking at how dramatically the FDIC changed the landscape of American banking. Since its creation in 1934, not a single depositor has ever lost a penny of insured deposits. Not one. Through recessions, through wars, through financial crisis, through the savings and loan crisis of the 1980s, through the Great Recession of 2008, the insurance has held. The coverage limit has been raised multiple times over the decades. From that initial $2,500 to $5,000, then to $10,000, then to $40,000, then $100,000, and finally to $250,000 per depositor per institution, where it stands today. The FDIC currently insures trillions of dollars in deposits across thousands of banks and savings institutions. But the story doesn't end with a neat, triumphant conclusion. Because the creation of deposit insurance, while unquestionably one of the most important financial reforms in American history, also introduced new risks and new moral hazards that we're still grappling with today. The critics who warned in 1933 that deposit insurance would encourage reckless behavior by banks were not entirely wrong. When depositors are protected, they lose the incentive to monitor their banks. And when banks know that depositors won't flee at the first sign of trouble, they may be tempted to take on greater risks, knowing that the government will backstop any losses. This dynamic played out with devastating consequences during the savings and loan crisis of the 1980s, when hundreds of insured savings institutions made wildly speculative investments, failed, and passed the losses on to taxpayers. The cleanup cost more than $130 billion. And it played out again in 2008, when the largest banks in the country, institutions that were deemed too big to fail, engaged in reckless lending and complex financial engineering that nearly brought down the global economy. The government stepped in with hundreds of billions in bailouts, and while depositors were protected, the underlying dynamic of socialized risk and privatized profit remained stubbornly intact. The question that the creation of the FDIC was supposed to answer, how do you protect ordinary people from the consequences of institutional failure, has turned out to be far more complicated than anyone in 1933 could have imagined. But here's the thing, when you look at the full sweep of American banking history, from the lawless free banking era of the early 1800s, through the recurring panics of the Gilded Age, through the absolute devastation of the Great Depression, one thing becomes unmistakably clear. The system was never designed to protect ordinary people. It was designed to facilitate commerce, to channel capital, to generate profits for those who controlled the institutions. Depositors were an afterthought. Their savings were the raw material that made the system work, but their protection was no one's responsibility. It took over 150 years of bank failures, of panics, of life savings evaporating, of families being destroyed, and ultimately of the total collapse of the banking system during the worst economic crisis in the nation's history, before the government finally said, enough. Enough with the fiction that the market will police itself. Enough with the pretense that ordinary people can evaluate the soundness of complex financial institutions. Enough with the idea that the consequences of institutional recklessness should fall entirely on the people who had no voice in the decisions that caused it. The FDIC was born out of catastrophe. It was born out of the failure of every other approach, and its creation represents one of those rare moments in American history when the political system actually responded to the suffering of ordinary people. Not because the powerful wanted it, but because the alternative, the complete loss of public faith in the financial system, threatened the very foundations of the economic order. The banks didn't get deposit insurance because they asked for it. Ordinary Americans got deposit insurance because they demanded it, because they had suffered enough, and because by 1933 there was simply no other choice. So the next time you walk into a bank and see that little FDIC sticker on the door or the teller's window, take a moment to think about what it represents. It's not just a logo, it's not just a government bureaucracy. It's the product of a century and a half of suffering, of loss, of broken promises, of ordinary people learning the hardest possible way that trust without protection is just another word for vulnerability. That little sticker is the reason you can deposit your paycheck without lying awake at night, wondering if it will still be there in the morning. And the fact that we now take it completely for granted, that we don't even think about the safety of our deposits, well, that might be the greatest testament to how profoundly it changed the American financial landscape. We've forgotten what it was like before. And honestly, given what came before, that's probably a blessing. If you found this story as eye-opening as I think it is, please hit that like button and subscribe to the channel. It genuinely helps us keep making these deep dives into the financial forces that shape our world. And if you haven't already, make sure to check out our video on the Rothschild banking dynasty. I think you'll really enjoy it. Thanks so much for watching, and I'll see you in the next video.